Now, even before the war, inflation was rising at the fastest rate in decades for many countries. That's also been the case here in Germany. New data out Monday showed producer prices surged by a record 26% in February. Energy costs have exploded since the data was gathered last month, setting the stage for even higher inflation going forward, or worse, stagflation.
After Russia invaded Ukraine, the price of oil and gas shot up to levels not seen in years. And that's been driving up costs for businesses and consumers worldwide. Like in transport, fuel is a major expense for freight companies. If they have to pay significantly more to fill their tanks, then they have to pass the costs on to their customers. This German logistics company says this will raise prices across the board.
That's true for everything, from yogurt to cars. In an economy based on the division of labor, everything we can imagine has to be transported. Ultimately, end consumers bear the additional costs that arise.
And those consumers are already seeing high prices at the fuel pump. They're so high that some governments are now looking to cut taxes on fuel or provide other forms of relief. And it's not just gasoline and diesel that have become extremely expensive. Food prices are also rising sharply. Wheat in particular. It now costs up to 50% more than before the war began. And that also makes staple foods like bread less affordable. The European Central Bank is predicting prices in the Eurozone will go up by 5.1% this year. It's revised its forecast upwards. This comes with economic growth weakening, especially in Europe. A forecast by economic analysts predicts a drop in economic output of 3.2% for the EU, compared to a scenario without war. Other regions are not as badly affected, but even so, overall global GDP is set to drop by 1.1%. Declining growth combined with rising prices, that's what economists call stagflation. Some predict the worst global economic slump in decades, like the oil embargo in 1973, which nearly paralyzed the world economy and led countries to scramble to diversify their energy supplies.
Now, for more on this, let's bring in Clemens Voigt from the IFO Institute in Munich. Clemens, we've seen, stagflation really come up as this eternal boogeyman. It's talked about all the time as one of the worst things that can happen to an economy. Why is that such a big fear?
It's a big fear because there isn't much governments can do about stagflation. In a normal economic crisis, demand declines, inflation is low, so the government can cut taxes and stabilize demand, or the central banks can print more money and stabilize demand. But with stagflation, it's very difficult. Inflation is high, so the central banks can't do much. They rather need to tighten, but that makes the crisis worse. So it really means living standards are going down.
Are we seeing that right now in Europe?
I think so, yes. We are seeing it in Europe. In the US, we have inflation, which is more of the boom type, so strong demand driving up prices. In Europe, we have inflation of the stagflationary, of the bad type. We don't have a strong demand boom. We have stable demand, but then energy prices, food prices are rising, and that's clearly a stagflationary shock.
So this morning we saw new data out on German producer prices up a record 26%. Inflation for consumers so far is running quite a bit below that at about 5%. Is this inflation about to get much harder for consumers?
It is, yes. Energy prices are rising, food prices are rising. So consumers see their real incomes going down. And it's not that domestic companies can compensate for this by paying higher wages, because domestic companies aren't producing oil and they aren't producing much food either. So consumers will definitely, and employees will take a hit in their real incomes.
So some of the price increases we've seen for things like natural gas or wheat as a result of the war in Ukraine are pretty staggering, really eye-popping figures. Do you see a risk of inflation becoming out of control?
Well, I wouldn't say it's becoming out of control. It's simply driven by these price increases, and there isn't much the central bank can do about it. At the same time, we see, for instance, the oil price, at the moment at least, stabilizing. So it's not clear where it's going, but it will really depend on the oil price. It would be out of control if wages were now massively increasing and we would get into a wage inflation spiral, but that doesn't seem to be happening. So I wouldn't say it's completely out of control.
Clemens Fust from the IFO Institute in Munich, thank you so much.
Thank you.